Okay, let's go ahead and get started. Welcome everybody, thanks for coming in today. It's good to have you here. We're going to do part 2 of a presentation Nicole started. It's actually a 4-part presentation, so we're pleased to have Nicole back in our webinar room, and I'd like to give her a welcome. Before we get started, as you know, we're going to read a disclaimer. Today's demonstration designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Equus and Thomson Reuters shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Nicole, I usually do a little bit better. That's memorized by heart, and I kind of stumbled through it today. I'm sorry. But I do want to welcome Nicole here. She does a lot of different webinars, and it's certainly good to have her here. Nicole, how many webinars do you give in kind of like an average month, would you say?
Well, good evening, everyone, and good evening, Jeff, and thanks for having me back. Right now we're only doing about 2 per month. We may be making some changes to our schedule to increase that, but right now it's just 2 for 2012.
Okay.
They tend to be on
Well,
Tuesdays if anyone's interested, but
okay. Well, it's great to have you. I'm going to let you go ahead and nobody wants to hear me rabble on for another hour, so I'll let you take over and kind of get going.
okay, great. Thanks, Jeff. And sorry about the minor glitch there at the beginning. I'm glad to see that I was able to come back in right away and everything is in working order. So thanks again for joining me. As Jeff mentioned, I conducted part 1. This was back in December on how to choose your strategy. And in that segment, we focused on kind of the setup about what we're trying to accomplish when trading from a high level sense. And the first part of that discussion talked about how, when you're looking at you're looking at 3 main things to get started, and that would be market direction, time, and news, and how those things impact your trading. For those of you who don't know me, I am from Trade King. I am the Director of Education, but I wear many hats. My background is in option market making on the MX. I also did some on the ISE. And I also have taught many people about options trading. And I hope that I can impart some of that knowledge to you with the goal of minimizing some of the mistakes that you are bound to make. That is just the way the market goes. But if I can save you some time, some heartache, and some money, I will feel like I have succeeded. So why don't we begin? I just want to tell you a little bit about Trade King, and thanks again to MetaStock. If you stick with me, I have a special offer to give you at the end if you become a Trade King client. Trade King is an online broker. We specialize in options, but we also have many stock traders, ETFs, mutual funds, and bonds. We're known for our great service, our tools, and we are we were the forefront in online trader community, known as the Trade King Trader Network. We have also low prices, $4.95 per trade, and for options trading, that's additional 65 cents per contract. If you trade 8 contracts or more, the base charge becomes $8.95, but we charge you only 15 cents per contract, and we only charge you 1 base charge for any multi-leg trade. Thank you to Matt for the shout out. I appreciate it. A little background on Trade King. We started back in 2005. We have over 200,000 clients, but our founders have much more experience than just 5 or 6 years in the markets. They started SureTrade back in the 90s when online trading was really just beginning. And finally, our main and only business is trading and allowing our clients to place trades through our platform. We are not market makers or anything like that. Here's the location for our trader network, community.tradeking.com, and we also share a lot of content on these various social websites. And finally, if you'd like more free education, please visit tradeking.com/education. You can check out all of our content even without a login. So we invite you to visit today. Don't worry, I'm not going to read all of them, but the most important disclaimer here is that this information is for educational purposes and is not to be seen as some type of recommendation or endorsement or anything like that. Just take responsibility for the trades that you make because you're the one making the decisions. Options aren't for everyone. There are risks involved, so please visit tradeking.com/ODD to get a full copy of the characteristics and risks of standardized options. And multi-leg option strategies involve additional risks, so please be aware of this before placing any trades. Okay, so long-awaited moment. Let's get started on how to choose your strategy. And in part one, like I said, I had set up the high-level view of how are you getting from point A to point B. What are you thinking about when you have a potential trade or finding a potential trade, and then what is going on during the life of that trade to end up at a successful outcome. And so that's the point A, the point B. Here, this is kind of a breakdown of the different steps along the way of moving from point A to point B. And what we're going to focus on tonight is part of it is in this number 4 here. Okay. We're going to talk about implied volatility. This has to speak to the problems you might encounter and how you can prepare for problems along the way. In part 5, also this speaks to the overall conditions in the marketplace and what do you estimate those conditions to be in the future. And then part 7 talks about how are you dealing with both known and unknown events and problems and so on. If you would like to review the other parts of this series, you can do so just by visiting this link, tinyurl.com/TradeKingStrategy, and you'll have access to all four parts of this presentation. And then for any additional technical analysis content, I'm giving you some quick links here as well. So thanks for that. Okay, so let's get to the topic at hand, which is talking about implied volatility. Well, before we talk about implied volatility and what our outlook is in implied volatility, let's define what we're talking about. The first thing that most people have heard about in regards to volatility of some kind is called historical volatility. So we're going to talk about this one first. Basically, there's a lot of fancy definitions about what historical volatility is. All you need to do is replace the word historical with the word stock. Okay, so this is just stock volatility, but this considers what was the change in price from one day to the next, one closing price to the next closing price. In most cases, there are other ways to calculate it, but that's the most common method in a stock over time. And those changes in price from one day to the next are put into formula. It's mostly measured using standard deviation. I'm not going to bore you with the details here, but it's giving you some reference point. So basically what it's saying is based on what has happened in the past, here is what is likely to occur in the future. Okay, but let's get a little more practical here. And what does it actually mean? So we're going to use stock XYZ, and this is how you would apply historical volatility. So let's say XYZ is $200 per share, and the historical volatility was calculated by some service as 30%. You can also use Excel to calculate your own historical volatility if you wanted to. So what does that mean? You would take 30% of 200, and that would give you $60. And you would then add and subtract $60 from the 200, and that would give you a range of 140 to 260 per share. Okay, and so what we're saying is, based on this calculation, it spits out 30%. Okay, again, based on past activity of stock movement. And that number, 30%, applied to the price of the stock, 200, gives us this change of $60. And if we add and subtract that from 200, we get a range of 140 to 260. So we're saying that based on past information, it is likely that in the next year, the range of this stock will be between 140 and 260. Okay, so that's the range there. Now there's a more chance than not that would be the range, but it's not guaranteed. Okay, it's just an estimate of what we think is going to happen in the future. So what is implied volatility? Well, when you hear the term implied, that should always signal to you options. I mean, it can mean other things, but for the most part, implied volatility is speaking about options. So what we're doing here to contrast it to historical volatility is we're using some kind of options information to project what we think is the range for the next year going forward. In historical volatility or stock volatility, we're using stock information to project what we think the stock is going to do in the next year. Implied volatility is using option information for what we think the stock will do in the next year. Okay? All right. So this is a number that you can only get using an options model. And that's why most people will get this number either from their broker's option chain or some other proprietary option service. But the main point of this, the practical application of implied volatility, is it becomes a proxy for the supply and demand of an option. Let's take a step back. So let's say you're trading stock, and I'm going to ask some questions to the audience, so if you want to participate in chat, that would be great. So when you're trading a stock and you get a high demand for those shares, what happens to the stock price? Right, it goes up, right? The stock price goes up when the demand increases. Okay, well, what happens to the stock price when the price, what happens to the stock price when there becomes an oversupply of shares? It goes down. Great, thank you. I really appreciate the participation. So the price goes down. Now, let's change gears to the options marketplace, all right? And an option derives part of its value from something else, right? That's why it's called a derivative. And so an option derives part of its price from the stock or the underlying, whatever the underlying is. I'm just going to use stock for this case, okay? So we already said that when the demand for the stock goes up, the price goes up. But now, what happens when the demand for the option increases? What happens to the option price? If the demand for the option increases, what happens to the option price? Okay, it goes up. Okay, we're going to go with the vanilla answer here. It can get a little more specific than that, but in general, if the demand for that specific option increases, the price is going to go up. Okay, if the supply for that particular option increases, okay, then the price is going to fall. The problem is, though, part of the input, or rather not the problem, but how it works is, how do we actually make the price of the option change when the price of the stock may or may not be changing? Okay, and that is what implied volatility reflects. The number of implied volatility gives you some indication of, is the demand increasing or decreasing? Okay, but you can't really just compare it to any, from ABC option to XYZ option. But I'm just trying to give you a practical use case, one way of what implied volatility says. What's happening with the supply and demand of these particular options? Okay, but as I mentioned before, it also speaks to the future stock price or range in a similar way that historical volatility does. And here's the application. So if XYZ is again $200 per share and the implied volatility of the at-the-money 30-day option is 40%, you would take 40% times 200 and gives you $80, and then you would add and subtract $80 from the 200, giving you a range of 120 to 280 in the next year. Okay, again, it's not guaranteed, but this is what we think is more likely the case. Now, I don't want to get into a big discussion about, what happens when the relationship between historical volatility and implied volatility is this. If we have time, we'll get to that later, but because that's not the focus of tonight. Tonight is the focus of implied volatility, but I have to kind of walk you through the different kinds so that you have a better understanding. All right, so now we're talking about implied. And we already said that this is speaking to the supply and demand of options. And we already said that actually we didn't say this, but I'm going to make this clear here. So higher demand or lower supply of an option is going to convey higher implied volatility. Higher implied volatility is going to mean higher option prices. Okay, and nowhere here have we talked about the stock. Let's go to the other side. Lower demand or higher supply of an option, what will that result in as far as implied volatility goes? Lower, that is correct. And if the implied volatility is lower, how will that impact the options price? Correct, also lower. Thank you. Okay, so that is the setup for what implied volatility is or does. Now we're going to talk about straddles, okay? And I'm not talking about this strategy. Straddle is an option strategy. I'm not talking about it as a recommendation, but the straddle is an interesting tool because it's also used as a barometer or gauge of volatility overall for that series of options. Okay, so let me define it for you. So a straddle is when you buy a call and a put at the same strike, the same month, the same quantity, and at the same time. Okay, I need to also define the gains and the losses here. It's theoretically unlimited. The gain is theoretically unlimited if the stock goes to the moon. I don't know how many stocks go to the moon, but hey, that's the theory. The max loss, though, is the cost of buying the straddle, which is the cost of the call, plus the cost of the put, plus the commissions for those trades. Excuse me. All right, so as I mentioned though, this is used as a barometer when talking about implied volatility. Why? Because this strategy has the most time premium of all the option strategies. We haven't defined time premium in this class, but I'm hoping that with the intermediate level here, this isn't too much of a stretch on people. But time premium is another way of saying extrinsic value, or fluff, if you will, as opposed to intrinsic value. Intrinsic value is the in-the-money amount, and option prices are made up of two components. One is intrinsic, which is in the money amount, and one is extrinsic, which is the time premium, or all the fluff, juice, vig, whatever you want to call it. So this strategy, the straddle, has the most time premium of all the strategies. And that's why when we talk about volatility, a lot of times we're talking about the straddle in some way, shape, or form. So options with high time premium are the most sensitive to changes in volatility, in implied volatility. Okay, and as I mentioned, we're going to talk about what we think is going to happen in the future. If you'd like more about straddles, please visit tinyurl.com/tkstraddle, and you have access to a fairly good amount of information there. Okay, so that's right, Bill. Straddle is the same strike. Often it's at the money. Okay, at the money means the price is closest to where the strike price is closest to where the stock price is today. So let's go over a couple examples. The first one, this is High Flyer online. Okay, these are real. This is real market data, but I've concealed the actual symbols. So at the time on June 6th, okay, this stock was around $185, and the next earnings announcement is going to be in about 6 weeks. The implied volatility was 30%, and the July 185 or July at the money straddle, because the strike price here, July 185, is close to the stock price. That one costs about $15. I know I'm using some old data here from June, but I'm going to update you on the current situation as well. These examples work well, so that's why I stick with them. And this is a snapshot from our option chains, and I've highlighted all the information up top in the green box. Tim is asking, would the put and call be the exact same price? And the answer is no, not usually. They might be close. In this case, you can see that the ask price for the call is $7.75, and the ask price for the put is $7. This would be considered, the call is slightly in the money to the put because the stock price is above the strike of 185. So that would also impact. That'd be one of the factors impacting that the prices are usually different for the calls and the puts. Okay, second straddle example is wash and wear retail. I took this market data at the same time as the other. This stock was around $80 a share. The next earnings announcement was in about 3 weeks. This case, implied volatility was lower than the other one. It's 25%. But the straddle, the at-the-money straddle actually costs a lot less. This was only about $5, $5.50 or so. Again, and here's a snapshot of that. In this case, you can see the ask price is $261 on the call and $282 on the put. Okay, so here are some things that might be running through your head right now. How do we compare High Flyer to wash and wear? How do we compare one straddle to another? How do we compare one stock to another? You know, what's going on? Why is the implied volatility different? Does that mean one's better than the other because one's higher or lower? You know, what are we really looking at here? Should you buy one of these straddles? Should you sell one of these straddles? And how are you deciding all this? So the key here is going to be, one of the keys is going to be relative implied volatility analysis. And this is what I'm going to teach you how to do. Now the setup here is, we're going to walk through the steps. I'm going to show you the examples. We're going to do another example so that you can get a feel for it. But the reason that I'm doing all this is because this helps the setup for part 3, which is, okay, now that I know what volatility does and how to make a forecast of what I think it will do in the future, now you need to line that up with a particular strategy that benefits when whatever circumstances you've outlined occur. Okay, so let's keep going here. Okay, so just as a recap, this analysis is using data from the marketplace to allow you to make a similar comparison. Okay, instead of apples and oranges, we're talking apples and apples. Okay, or if you want, as a shout out to a couple New Yorkers on here, you know, getting a slice of pizza versus Sicilian, right? Those wouldn't be similar. I don't compare Sicilian pizza to a slice. Okay, I compare slices to each other. I compare Sicilian style to each other. I guess I'm hungry. What can I tell you? It's 7:30 in North Carolina. So, okay. So what this is important here, though, is we're letting the market tell us what is going on. Okay, we are not forcing our will on the market, and that is really important here. So we're letting the market give us the information to figure out what's happening. Because when we do that, the market is telling us what's likely to be successful and what is not. Once you understand what the market is telling you and how to read the signs. Okay. So I'm going to just plow through these steps, and I'm not going to read them to you right now because they're not going to mean anything. Let's go right to the visuals, and I think that's going to explain what we're going to do. As a reminder, if you would like a copy of the slides, please send an email to webinars@tradeking.com, and you'll get the slides tomorrow. For part 1 or part 2, just indicate what you're interested in. Okay, so let's go to the visuals so that you can see what we're talking about here. Okay, this is a volatility chart for High Flyer Online, taken from the TradeKing website. There are 2 lines on this chart. The yellow or gold line that I'm tracing right now, that is implied volatility. Okay. The white line down here, that is historical or stock volatility. Okay. Nowhere on here is there a price action chart. There is no stock chart here. All that's here is historical volatility in white and implied volatility in yellow or gold. Okay. Slide email address is right here at the bottom. So this is what we're going to do. We are going to define the low of implied volatility here. This one happened to be 27. We're also going to indicate what the high was. That was 52. All right. Okay. Low 27, high 52. Here was the high, and here was the low. Okay. Next thing you're going to do is, so this is the range. It was 27 to 52. You're going to take the difference, and that comes out to 25. Okay. So the range spans 25 volatility points. The next thing we're going to do is we're going to divide that range into thirds. Okay. Why thirds? Because I said so. I mean, I want to make this an easy concept to digest, and making it in thirds is easy to do that. You can get more specific if you would like, but we're just going to focus on the easy thing right now because I want you to really get this concept. It's very powerful if you get it. And it's something that is really overlooked. To be honest, I haven't heard anyone else speak about this topic, and I think it's very important. Okay, so we're going to take the range in points of 25, divide that by 3, as you can see right here. That comes out to 8.3. If I take the 8.3 and I add it to the low, that's going to give me this boundary line, okay? Because what's happening is I'm dividing this whole range into 3 parts. And I need to define what are the limitations for each part. So the lower third is between 27 and 35.3. And then the next one is between 35.3 and 43.7, and then 43.7 and 52 for the upper one. Okay, and these are the calculations associated with defining these boundaries here. Okay, so basically what we did here is we have drawn a map. Okay, that's it. We've just drawn a map to help us look ahead. What we need to do next, though, is we need the "You Are Here" sticker, okay, or the GPS, right, to say, you know, recalculating, right? It needs to tell us where we are right now. And where we are right now is here, okay? Now, we knew that at the beginning. I showed you a blank version of this chart without all these lines on here. But if you don't have a trained eye, that may not really signify much to you, okay? In this case, maybe it was kind of a little obvious, but I don't want to make those assumptions, so I'm laying this out for you. Okay, so here are the steps that we just went through, 1 through 6, okay? And now this is the "You Are Here" sticker. For number 7, determine which third IV is now. And we've determined that it's in the lower third. Actually, pretty close to the low of the lower third, because it's pretty darn low. Now we need to estimate what the future direction will be. Okay, now we haven't really talked about how we're going to estimate that, so I need to give you some more background. And to answer Manesh's question, is the IV for the option selected or for a basket of options based on the moneyness? Okay, when I showed you the screenshot of the strike prices in the option chain, that implied volatility number is specific to each option on that screen. This chart here, though, is created by using the at-the-money options for the first and second month of the series at all times, okay? Because it needs to kind of make it some kind of smoothness factor in order to get data that you can use. If you don't have this smoothing practice of using of 2 at-the-money options across 2 terms, and that actually might involve 3 options that are close to at the money. So the at the money option, 1 in the money strike and 1 out of the money strike. Without using all of that, the data would not, we just really couldn't make sense of it. And so this is a proprietary model, that the proprietary calculation they use to give us this data on this chart. Okay, so we've defined the lower third, the middle third, and the upper third. We're in the lower portion of the lower third. And from here, I am going to estimate the volatility is going to increase. Okay, that's my projection here. And I'm going to tell you why. There is a principle of implied volatility known as mean reversion. Okay, and all that means is this is a rubber band. If you stretch the rubber band too far to one side, the rubber band just wants to snap back, right? If you stretch the rubber band to the other side, it just wants to snap back again. It just wants to come back to the center. And when you have a chart like we have here, where it seems to be stretched all the way to the lower side, the tendency is going to be to go back towards the middle. Okay? And so because the tendency is for it to increase or go back to the middle, meaning increase, That's one of the reasons I think that implied volatility will increase between here and expiration of July, whatever the third week of July was for these options. Okay, that's the first reason. Again, it's not guaranteed. I mean, you know, just because we're at a stretching point here in this current example, it doesn't mean that it couldn't go lower than the low. It can. It's just that we're looking for something that's going to improve our odds of being successful, and so that's why we're going with this theory. Okay. So, but what else? What else does it tell us? Okay, it tells us what's happening right now. What's happening right now is volatility is low. Well, what does that mean? It means that not a lot of excitement is expected right now, or there's not a lot of excitement occurring right now, rather, is the better way to say it. Okay, things are quiet. But what else do we know? There was some piece of information that I told you in the beginning when I gave you these examples. Does anyone happen to recall something I was saying was going to happen in the near future? And I'll give you a hint there. Okay, very good. Felipe says earnings, right? And Manesh says it needs a news event, and that's right. Okay, so I know when earnings are coming out because I looked it up. And what do I know about earnings? I know that most of the time, implied volatility is at a peak the day before the earnings announcement. Okay? That's right, Joe. This is the catalyst, or one catalyst, for a movement in implied volatility. Okay? And so already we're starting to combine parts 1 and 2 of this series, because part 1 was talking about, well, what's happening in the news? What do you know that's coming on the horizon? Here we're saying, okay, all right, so I'm doing a volatility analysis and volatility looks low. Okay, great. Well, what am I going to do with that? Well, I think it's going to increase. Why? Well, earnings is coming up, and volatility tends to peak right before earnings. Great. So here you can start to see the pieces coming together. Next week, we would talk about a strategy that would benefit greatly from implied volatility increasing between now and earnings. Okay? And so, I'm sorry, did I say next week? Whatever. Part 3 is what I'm talking about there. So, we need the catalyst. We need to know where we are. You put those things together and you come up with a forecast. And that's why I think that the implied volatility is likely to increase. Okay, the question is though, when? I don't know when. Okay, we don't have that guess. Okay, I just know I think it's going to be between now and earnings. When? I don't know. Could it go down first before it goes up? Yes. That is definitely possible, and it happens, okay? But again, we're going with improving our odds of success, so we're trying to get all the cylinders working together and moving the bus forward. Okay. Again, why would IV increase? Earnings or some other news that you know is coming out, or some other catalyst. Okay, I said it was still possible implied volatility could decrease, okay, but we're just trying to stack the odds in our favor. Okay, so we're looking to choose a strategy that matches the following. Implied volatility is currently low. Implied volatility is expected to rise, okay, and that's what we're going to talk about next time. All right, so this chart here is the same chart that we just looked at, and what I've done is I've highlighted all the times when earnings were announced. Okay. And you can see, I tried to make it transparent, the sign's transparent, but you can see that in 3 out of 4 times, there's a run-up in implied volatility about a month out. Okay, so leading up to the October announcement, it started out down here somewhere, moved up to here, and then it dropped off. Okay, that's the day of earnings announcement, is that sharp decline. It did it again for the January announcement, going up and down. And then for the April announcement, not as significant, but still quite a sharp decline there. It did not follow that pattern for the July earnings announcement, okay? Meaning that you didn't get the peak before the July announcement. It occurred sooner, towards the beginning of the month or the end of June, but you still got the sharp drop off. Okay, so things may not happen anyhow that you expect, but if you get the rhythm down, you can get a better sense of what's happening, what to look for, and so on. Okay, and this chart here, this is as of February 6th, just a few days ago, and you can see that this announcement here, I think when we looked at this, let's go back. So when we looked at this, the vol was around 30% and we were looking ahead to the July announcement, and the July announcement peaked at about 42%. So the volatility increased 12 clicks, as we say, or percentage points, between when I looked at this trade and the actual earnings announcement. Okay. And, that's what I was looking for, and that happened just as I thought it might. And then also, a little more erratic behavior here, but similar pattern. You got the spike up, it came down, you got the spike up, it came down, and so on. All right, so Mark is asking, volatility can't possibly get any lower. It can always get lower. Okay, it can always get lower. I don't know where the VIX is right now, off the top of my head, but whatever it is, it could be lower. When, for how long? I don't know. Thank you, John. It's 18. That's way high in what it has been at some points. It's been in the single digits. So, but many people might think that 18 is quite low compared to what it was doing. A good thing to do here would be to look at the SPX implied volatility chart, which would give you what the VIX is doing. And after I get through this next example, maybe we can take a look at that. All right, so this is what I'm doing. I'm setting up the same thing for the other stock, Wash and Wear. It's a recap of the data that I gave you up at the beginning, again with the option chain. And we're going to go through each point here. We're going to define the high and the low, figure out what the range is, divide the range into 3 parts, then figure out the boundaries for each of the thirds, and figure out where we are. We're laying the map, and then we need to look at where we are in relation to that map. All right, so here we are. Here's the volatility chart. Looks different than the other one, right? Remember, gold or yellow is the implied volatility line, and white is the historical line. There is no price action on this chart. This is available with every TradeKing account, so please check it out. Okay, so we're going to draw the highs and the lows. Here the high is 39, the low is 16. And take the difference. That comes out to 23. And then I'm going to divide 23 by 3. That comes out to 7.7. That's going to help me draw these lines here and here. And then I'm going to determine where I am right now. And here I'm still in the lower third, but I'm in the top of the lower third. Okay, so relatively speaking, is volatility currently higher or lower than the previous example? Very good. Okay, Relatively speaking, the volatility of wash and wear retail, okay, assuming that we're just looking at this date of June 6th when I captured this data, it's higher than it was for high flyer online. Okay, the absolute number is not. Okay, this number is 25. The other one was 30, let's say. Okay, so absolute number was higher, but when you are looking at the observed, when you look at the behavior of the volatility for the particular options on this underlying, relatively speaking, the options on high flyer are quote unquote cheaper than the options on wash and wear. Okay. Manesh has a great question. Would the quartile analysis you are conducting be more accurate if the date range is increased? Well, first, I'm not giving you quartile analysis, but you could divide this into fours and do it in quartiles for sure. And like I said, you could make this range, sliced into smaller and smaller pieces, right? But I'm just trying to convey just a gauge, a visual gauge, if nothing else, on what you're looking at. If you change the date range, yes, that's going to affect what the forecast might be. You might decide to go for a shorter forecast. You might decide to go for, a shorter time period to examine. You might want to look at a longer time period to examine. But you want there to be something, you want there to be some kind of consistency or at least general application to what you're trading. If you're only going to trade an option for a day, are you going to look at what the yearly implied volatility range is? Maybe, but maybe not. I mean, if you're trading a deep in the money option, well, I don't really care so much about implied volatility, right? Because that's really a substitute for the stock. It's much more important about what's happening in the stock. If I'm trading an option that's at the money, 3 months out, yeah, implied volatility is really important to me because I want to know is it impacts that option price greatly, much more than a deep in the money front month option. So you can definitely vary the time period that you examine, but you do want to make sure that there's some kind of application to what you're going to trade. If you're making an earnings play here and you're going to be in this trade for a few weeks, I think using a yearly chart or a 2-year chart is helpful because you can see the rhythm develop over that time. Doesn't mean it's going to happen that way this time when the earnings come out, but it might. That's all we have to really go off of. So hopefully it's helpful to you. Okay, Al is asking you a great question. Can trend be determined by looking into implied volatility? Does anyone have an answer they would like to put forth here? Al, this is a great question. I'm really glad you asked because this is it's an important concept I want to make sure everyone gets here. Okay, the answer is no. Volatility, whether it's historical or implied, is only speaking to a possible range. It's not speaking to a direction. This is really, really important. Okay, so your thoughts on direction must come from some other place. Implied volatility is not going to help you there. Okay, so for this example, even though volatility is higher than it was, relatively speaking, than the previous example, I still am going to estimate that it's going to increase. Why? Again, we have a catalyst coming. This one much sooner. This one's coming up in about 3 weeks. And so I think that implied volatility is going to go up from here. Now, am I willing to make the same bet on a strategy as I would in the previous example? No, because the rubber band has started to come back to the middle. It's not all the way back to the middle, but it's more towards the middle than the other example. And so I need to assess my risk accordingly based on the information the market is giving me. Now, Mike makes an interesting comment about direction and volatility having an inverse relationship. It is not that volatility and direction have inverse relationship. It is the movement of volatility and direction that have an inverse relationship. So typically, if volatility is increasing, direction tends to be decreasing, tends to be going down. If volatility is decreasing, the direction tends to be increasing. But again, that does not tell you which way it's going to go. Okay. As a case study, what you might want to do is look at a chart of implied volatility over the past year and look at a chart of price action over the same time period with the earnings date highlighted. And you can see that volatility is usually spiking around the time of the earnings announcement, like we discussed. But then take a look and see what the stock price is doing. It may be going up, it may be going down. It's really hard to say. And to be honest, even if I knew what an earnings release was going to be before it came out, it still would be difficult to anticipate how the market would digest that information unless it was a real outlier. As you know, sometimes when they beat the number, the stock's down. Sometimes when they miss the number, the stock's up, right? Does that make any sense? No, not really. It's all about where did the number come in relation to the expectations of the market. But sometimes even the market doesn't know what it expects. So volatility and direction, it's not a safe bet. It's just giving you a range of future movement. That's right. Volatility just a term. It just indicates how much change there could be. That is correct, Mark. Okay. So, again, this is just a review of everything we talked about. The environment is somewhat quiet this time, not as quiet as it was. The odds are likely implied volatility will continue to increase. When? We don't know, but between now and earnings is what we're looking at. It's already started to go up. Why? Again, earnings. How can we use this? We want to pick a strategy that matches these characteristics in this forecast. Okay. Again, this is just a kind of point of reference. You can see it follows a similar behavior. Peaking at the announcement, falling off, peaking at the announcement, falling off, and so on. This one, though, not as rhythmic as the other. And then 3 days later, the volatility went from 25 up to about 28, and that happened to be the middle of the top of the middle of the range. So it's banging up, it's hitting up against getting into the top third of the range, indicating that volatility would be high almost at that point. This is a current chart from a few days ago, and you can see that the high for that announcement was about 33. So it went from about 25 to 33. Considerable move, even for a 25 vol stock. Okay, so let's recap. High flyer at the money vol is 30. Wash and wear is 25. Is one better than the other? The answer is no. Okay. It really depends on what you're trying to do, what your strategy is, what you think, and so on. Yes, Mike is asking a question here. Let me just make sure I didn't miss any other questions. Okay. Let me answer Mike's question, then I'll go back to Richard's question. Mike's question is, does TradeKing provide scans? Yes, we provide scans on options data that you can find relatively low implied volatility stocks or high implied volatility options, I should say. based on an underlying. And to Richard's question, he says, doesn't high and low vol just mean the option is cheap or more costly? And would anyone like to answer that question? Richard, I don't mean to single you out. Again, this is another great question. I'm really glad someone asked it. So the question is, does high and low vol mean the option is cheap or more expensive? Anyone have an answer? Manesh is the A student of the night. He says this will depend on the implied volatility relative to its past position or past implied volatility. That is correct. Okay, so if somebody says to you, oh, the volatility is 45, and they say, wow, that sounds high, and they're asking you for your opinion, the answer is, I don't have enough information to make that determination. Really, to determine if the volatility, the implied volatility, is high or low, you really need to look at what is typical for that particular series of options on that underlying, like I showed you tonight. Matthew is asking about beta and higher implied volatility. There's probably a correlation there, but I don't know enough to speak to it. Stocks with higher betas probably have higher implied volatilities. Well, but not necessarily, because again, implied volatility is calculated using an options price. You might be able to say that higher beta stocks tend to have higher historical volatility because those are more apples and apples comparison based on stock price movement. To make that stretch to the options market data, that's harder, so I'll leave that one out. Correct, Mark. You need to compare the apples with the apples. Yes, Ken. High volatility option means that the price is high. Usually, I mean, not all the time because of how the model works. You know, you can have an option that costs 30 cents and the volatility could be 100. But that's kind of getting into those long tail items. But on average, if you're saying the volatility is going up, that means the option price is increasing. Okay, so that wraps up tonight's session. I think I've answered many questions tonight. I really appreciate the participation because that really helps me understand where you are and what to speak to and points to highlight. I really, really appreciate the participation, probably more than anything else. If you're interested, I will provide you links to access part 3, or if Jeff and I work out another date in the future, I'd be happy to come back and speak to you directly about part 3 and how you align your outlook with the Greeks. And so here are the links again. And if you'd like the slides, please send an email to webinars@traking.com. And as promised, here is the promo from Traking. If you open a Traking account, you will get $100. And if you are a current Traking client, you are also eligible for the $100. You just need to send me an email. What you need to do, though, is open a Traking account, or if you already have a Traking account, wonderful. Use this link. Okay, so it's tinyurl.com/TradeKing MetaStock 2012. You need to fund your account within 30 days. Current account holders would need to make an additional deposit within 30 days of today's webinar with at least $3,000. And if you make 3 trades within 3 months of the account opening, you get your $100. So all you got to remember is threes, right? Fund within 30 days, fund with at least $3,000, make 3 trades, and trade within 3 months, and use this link to get this offer. Again, thank you very much. Thank you very much to Jeff for having me. I really appreciate the opportunity to speak to you all. If you'd like to get in touch with me, please email me at webinars@traking.com. Visit me on Twitter and visit our education center.